Hey everyone, this is Logan Hertz with Hazeltine LLC, and for this video, I thought we'd just go over an article that I've read in the past that I think is very relevant to one of the topics that comes up often, which is what should I do with retirement accounts? If I have money in retirement accounts, whether those be Roth, 401k, 403b, whatever it is, what should I do with that money? And if I'm contributing to retirement accounts, should I keep contributing? How much should I contribute, etc. Now, there is no one answer to that. The answer is it depends on your situation. But I do think you need to have a plan. And I think a lot of people contribute to retirement accounts without really thinking about why am I doing this? What benefit am I getting from it? And what are the real trade offs I'm making? In particular, the lack of liquidity, access, and control that I have in this particular vehicle. And I'd like to just read to you an article from Dr. Bob Murphy, who is a PhD economist, explaining why he actually cashed out his 403b. He's an academic, so in his case, his retirement account is a 403b, and took the proceeds and put it into his infinite banking system. He also practices the infinite banking concept, and he is a brilliant PhD economist. So certainly no dummy when it comes to money. So I think you know seeing his perspective could be quite valuable. So I'm actually going to share the text of this article and just read through it and maybe add a little bit of commentary, but I don't think I really need to add a lot of commentary. I think this article speaks for itself. So this is Dr. Bob Murphy. This is from the infinitebanking.org website. I'll link it in the comments below. Why I cashed out my 403b. So here we go. So Dr. Bob Murphy, I spent a lot of time motivating difficult financial topics by constructing thought experiments. In a thought experiment, you can only focus on one or maybe two moving parts while holding everything else constant. This is the way to isolate the impact of the factor you want to understand. However, it means the whole exercise is necessarily unrealistic. That's why people respond more when someone tells them an actual story about something that happened relevant to the topic. Effective speakers know this. A polished preacher, for example, can connect even with a cynical atheist by telling an anecdote that illustrates something fundamental about human nature. For these reasons, I thought it might be worthwhile to explain why I recently cashed out my 403b and used the proceeds to, among other things, buy some more paid up additional whole life insurance and some Bitcoin. Since my moves fly in the face of conventional financial counseling, I thought it would be useful to explain some of the major considerations in my decision. It should go without saying that I'm not offering formal investment advice in this essay. I'm just explaining why I did what I did and letting the reader take any of my remarks into consideration when planning for the future. So, why I had it. I first should explain why I started out with a decent amount, just so you have some idea. It was more than $15,000, but less than $75,000 in a 403b. The simple explanation is that part of my compensation package for a spell in academia was a mandatory contribution to the tax qualified retirement accounts designed for the educational sector. It's basically a 401k for teachers. Now, even within this framework, I should mention that I was unusual. I had everything in either gold mining stocks and treasuries, with a portfolio heavily weighted to the gold. When I first set it up that way, the guy from Fidelity was doing his best to lecture me about the benefits of diversification. As a PhD economist, believe it or not, I was familiar with this concept. I told him I had other assets filling out my desired overall portfolio. Here I was primarily thinking of my existing IBC policy, and so my 403b was helping to check the box of hedging myself against significant price inflation. And after my 403b appreciated some 20% in the first year, the guy from Fidelity never bothered me again about it. Liquidity. However, I recently left academia for family reasons and am focusing more on entrepreneurial ventures. As such, I wanted to enlarge my pool of liquid funds. I wanted to free myself to focus on the most productive projects rather than being forced to pick projects that would yield their fruits in the near term. In short, I wanted to increase the liquidity of my portfolio, and having a pile of wealth sitting in a 403b when I'm in my young 40s wasn't very useful to me. Because of the various enterprises I've set in motion, I'm not worried about my long-term solvency. However, my immediate need for liquidity was pressing. This is why I resolved to withdraw the full amount from my 403b in order to bolster my checking account, make a significant purchase of paid up additional life insurance, pay down some important debt, donate to the church, and to buy some Bitcoin. I'm not going to do justice to the explanation for why I used the money the way I did. Carlos and I outlined our economic prognosis and why we thought people should acquire actual cash, currency in the home vault, an IBC life insurance policy, and gold and silver coins in the video presentation, How to Weather the Coming Financial Storms. For an explanation of what Bitcoin is, I co-authored with Silas Barta, available at understandingbitcoin.us. I will parenthetically add, like most explanations of Bitcoin, it's useless, it's way too technical, it'll just leave you confused, so don't bother. He's an academic. That's what he is. Okay, moving on. In the remainder of this article, I try to explain why I decided to get on my 403b. Borrow. I'm not going to summarize the nuances here, but suffice it to say, if you want to borrow against your 403b or other tax-qualified retirement account, there are incredibly onerous payback rules. Basically, they only let you use your money if you don't need it. So although I initially thought I would just temporarily put my gold mining stocks on hold, when I saw the actual rules, I decided it made more sense just to liquidate the whole thing, period. I can buy gold mining stocks down the road if I want them again. Tax implications. The most obvious objection people raise to my decision is the tax implications. First, I had to pay income tax on my withdrawal. Second, I had to pay a 10% penalty because it was an unauthorized early withdrawal. Now, let me add my own commentary here. The point that I would make is the money you have in a 401k, the advertised dollar amount is just fantasy. It's just advertising. Okay, they can advertise that you have $1 million in the 401k, but you don't actually have $1 million. There are taxes and penalties because they want you to keep your money locked up in their jail for as long as possible, and they will penalize you and tax you if you try and withdraw it. So really, ask yourself, as Benton Penn would say, what is the cash surrender value of my asset? Meaning, if I wanted to liquidate the asset today, what could I get? And that gives you a much better idea of the actual value of the asset. So they say you have $1 million in a 401k. That is not true. What you have is what you can actually get your hands on, which means if you cash it out, how much could you actually get? Maybe half, maybe half. So I would say you never had that money to begin with. It's not that you're being taxed and penalized, it's that you never had that money to begin with. And by the way, you're being charged fees on the full amount, even the money that's not yours. Okay, probably at least 25% of that belongs to the IRS plus the penalties. So you're being charged fees on money that's not even yours. And of course, even if it's not going to be taxed, the market could go down. So what do you actually have? That's a better question. Okay, returning to the article, Bob Murphy continues. Let me just stop and observe that this is really screwy. It is a sick joke that the United States federal government, which is anywhere from $40 trillion to $200 trillion in debt. I add parenthetically, this article is not recent, so those numbers, I mean, it's a few years old, so those numbers are probably even higher now. Depending on how we evaluate the promises made via Medicare, is spanking people if they have the audacity to try to use their own wealth earlier than the government deems appropriate. If for no other reason than to withdraw consent, I had an urge to get out of this paternalistic system. Yeah, and I'll add my commentary. Control, right? Who has control? Liquidity, access, and control. Liquidity, access, and control. That's what you want, okay? Who has control? That's the question. Even if your portfolio performs well, again, who has control? What do you have access to? Okay. How is it impacting your lifestyle in the present? All right, returning to Dr. Bob Murphy. However, we can put aside ideological considerations and just look at the numbers. If we, for the moment, set aside the penalty, the simple fact is that, holding everything else, like annual income and the tax code constant, it is a wash whether you pay the tax now or later. This is a critical point, so let me walk through a specific numerical example. Suppose you're 40 years old and you have $100,000 in a 403b that is earning 5% annually. Further, suppose the tax code right now for the next 25 years will be a simple flat tax with a single bracket that applies a tax rate of 30% on any income. Now, if you leave the money in your tax qualified account, rolling over tax deferred until you're 65, then the 403b will have reached a value of about $339,000 when you turn 65. At that point, if you take it all out, you will at that point pay the 30% flat tax, leaving you with a remainder of $237,000. On the other hand, suppose you rolled it into a Roth IRA, where you pay the tax upfront on the contributions, but then you enjoy the principal and growth without further tax liability. In this case, you pay the 30% flat tax upfront on the $100,000, leaving you with $70,000 to go into your Roth. Then that $70,000 rolls over at 5% annually, reaching a value of $237,000 by the time you turn 65. Then at that point, you can spend your $237,000 free and clear because you already paid the tax on it. Okay, let me add parenthetically my own commentary. There are so many unknowns here, right? Like, what's the market going to do? Who even knows? Okay, this is not a savings account. You're gambling. What's the S&P 500 going to do? How well are the mutual funds picked, right? What are tax rates going to be in the future, right? We don't know any of these things, and you have no control over how the S&P 500 performs. Neither do I. Okay, so this is not a savings account. You have no guarantees. And if you're going to make investments, I prefer making investments where you actually have control over how that investment performs, like, say, buying real estate or starting a business. Okay, this is actually speculating, and there's nothing wrong with speculating, but it's important to understand the difference. This is not saving for retirement. This is speculating in an asset, if it even can be called an asset, where you have no control. And again, people have succeeded with this, so I'm not saying you can't be successful, but just understand all of the risks you're taking on. Okay, to return to the article. As this simple example shows, if we hold all the other moving parts constant, then it is a total wash, whether you pay the tax upfront or on the back end. There's nothing about the time value of money that makes it advantageous to be in one type of tax treatment versus the other. Yeah, and again, I think this is important to point out. People think of these retirement accounts as being tax advantaged. I don't see the tax advantages, quite frankly. I've never seen them. Unless you think tax rates are going down in the future, I really don't see how these are tax advantage accounts, quite frankly. Yeah, I don't see it. I think, well, I won't go too much further on that one, but just calling them tax advantage, I mean, I question that. Okay, paying the penalty. But what about the 10% penalty? I would call it a ransom. Your money's in jail, you got to pay a ransom if you want to free the hostages, as someone else says it. Okay. But what about the 10% penalty? It's true that that's painful, but on the other hand, I had reason to suspect that leaving my wealth inside the 403B would create other problems down the road. To name just two, my income will probably be higher in 25 years, and I'm quite sure that marginal tax rates will be higher than they are now. And then you see this interesting graph of the top U.S. marginal tax rate. You can see how relative to what tax rates have been over the past 100 years or so, we're actually in a pretty low tax rate environment, believe it or not. Believe it or not. Okay. And he says, look at the following chart of the top federal marginal income tax rate in the United States. Notice that in figure 1, it stops in 2008. The current tax rate is 2 percentage points higher than what is shown in the figure. Does it look like our current top rate is high or low compared to its historical levels? It's true that with globalization and the ease of travel, it's more viable for highly talented individuals to simply leave the country if things get too onerous. Because of this, governments around the world have had to dial back their individual and corporate income tax rates, just like US states can't be too outrageous lest they drive too many people into hospitable states like Florida and Texas. On the other hand, the US government is racking up debt at an extraordinary rate, particularly considering that the official unemployment rate has been so low. Here's the latest projection from the CBO, and you can see from the graph. Things are even bleaker when we consider the ludicrous proposals that the current Democratic presidential candidates have been throwing out, including Elizabeth Warren's nearly $52 trillion over 10 years takeover of healthcare. And that's her number, not a critical estimate. These considerations helped me to decide that the 10% penalty for early withdrawal was the lesser of two evils compared to the possible tax treatment if I left my wealth inside the 403B. And I'll just add again, another huge thing is opportunity cost, right? You have your money locked up in jail. There's a huge opportunity cost of you not being able to access it and use it in other potentially better ways, right? In particular, if you start to put that money, feed it into your infinite banking system, think about all the compound interest you could earn over the next several decades, right? So yeah, you're going to pay a penalty, but what about all the opportunity costs you're paying without seeing it of leaving your money locked up. Okay, continuing on. Now, to be sure, the government might come after me down the road anyway, even if right now it promises not to tax the growth and the cash surrender value of my properly designed and handled whole life insurance policy. Still, on balance, I decided that it was more dangerous to leave my wealth in the 403b than to take it out. Conclusion. The world system seeks to control every aspect of our lives, ranging from the food we eat to what our children learn to what news we can even read on Facebook. And one of the tightest strangleholds they have is on the financial system. Uncle Sam literally nationalized the creation of paper money and created the Federal Reserve System to cartelize the commercial banks to allow them to issue their own money in the form of demand deposits. Carlos and I explain this in our book, How Privatized Banking Really Works, available at www.lauramurphy.com. Among other tools, the tax code itself has been designed to herd everybody into officially approved assets. They especially discourage new entrepreneurs by heavily motivating salaried professionals into locking up their wealth in prison for decades. Given its track records, do you trust the US federal government's advice when it comes to fiscal management? You can do what you want, but I decided to cash out my 403b. Okay. So I also want to add that that's exactly what I did. Back when I was working as a W-2 employee, I had an employer who offered a very generous match on a 401k, and I contributed up to what my employer would match and no more. And then after a while, I eventually decided, why do I have this money here? I actually rolled it into an IRA and then cashed it out and paid the penalties and paid taxes on it. The reason why I rolled it into an IRA was because I was able to get out of some of the, there were some deductions, or I was able to get out some of the penalties. Okay. But again, this is Bob Murphy, PhD economist, explaining why he cashed out his retirement account and put the proceeds into his infinite banking system. I'm not giving financial or investment advice here, but I think it's important to take a look at an alternative perspective on retirement accounts, especially from someone who has a stature of Bob Murphy. So I will link this in the description below. And I hope you all enjoyed this video and learned something from it. Thank you very much. Bye-bye.